when you turn your attention over to what's going on in tech, you were talking about Taiwan Semi and Nvidia. Do you like both those names or what?
Yeah, we do. Nvidia is the largest position in our strategy. We think that AI infrastructure investment remains feverish. Demand for AI compute remains quite a bit above the supply. And believe it or not, the gap between those two has expanded over the last 6 months. So we think Nvidia is an outstanding investment here over the next couple of years. We think that CapEx numbers for the big hyperscalers and also the kind of tier 2 neoclouds, which includes Oracle, which you just mentioned a few minutes ago, their CapEx spending is going to continue to be revised higher. That's been happening over the last year or two. I think it's going to continue for the next year or two. And that makes NVIDIA one of our favorite ideas.
AI adoption is still in its infancy, according to the majority of experts, and NVIDIA's chips are the industry standard for enabling the technology. While Wall Street is still optimistic, some investors are worried that AI has peaked due to the inevitable ebbs and flows of adoption. NVIDIA remains reasonably valued despite its recent explosive growth, especially considering the size of the opportunity. In recent months, investors have been alarmed by rumors of an artificial intelligence, AI bubble, which has caused the market to climb a wall of anxiety. However, the reality is far more nuanced. In actuality, the adoption of AI has encountered challenging competition due to early sales that were so strong that growth rates have slowed. Doubt has been seeded as a result of this, as well as the normal ups and downs of adopting new technologies. However, if we take a step back, the results are still strong. One of the best examples is Nvidia. The business invented graphics processing units, GPUs, which are chips that supply the computing power necessary for AI inference and training. Although the proportional growth rate has slowed, the absolute demand for these AI accelerators is still substantial. Although investors criticize the company's most recent quarterly report, Nvidia's continuously impressive performance shows that it has a clear route to joining the $7 trillion club as a charter member. Let's examine the outcomes and the conditions that must be met for the stock to achieve these exceptional levels. Nvidia has been a profitable investment for investors by all standards. Following the company's initial public offering, IPO, in early 1999, those who were able to purchase the shares right away saw cumulative gains of 469,300%. To put this into perspective, a $100 investment made 26 years ago is currently worth $469,440. Moreover, the outcomes are not relegated to a bygone era. For instance, the stock has increased 29,450% in the last 10 years. The value of that $100 investment would be $29,050. The start of the AI boom has fueled its expansion in recent years. Nvidia achieved record sales of $46.7 billion in the second quarter of fiscal 2026, which concluded on July 27th. This represents a 56% year-over-year increase. As a result, adjusted profits per share, EPS, increased 54% to $1.05. Strong demand for chips from the business's data center division, which provides CPUs for cloud computing, artificial intelligence, and data centers, drove the outcomes. Due to the ongoing need for AI, data center revenue increased 56% to $41.1 billion. Although this is a slowdown from Nvidia's triple-digit growth in fiscal 2025, the first spike in demand made competition fierce. Demand is still phenomenal, as management is projecting third-quarter revenue of $54 billion, which would double Nvidia's total revenue for the entire fiscal year 2023. Most likely, this is only the beginning. By the end of the decade, we anticipate spending between $3 trillion and $4 trillion on AI infrastructure, according to CEO Jensen Huang. Nvidia is well positioned to benefit from these tailwinds because it is the industry leader and industry standard for data center GPUs. At the moment, Nvidia has a market valuation of almost $4.7 trillion. This indicates that it will only need a 56% increase in stock price to reach $7 trillion in value. Wall Street estimates that Nvidia will make around $206 billion in revenue in fiscal 2026, which would translate into a forward price-to-sales (PS) ratio of 23. To support a $7 trillion market cap, Nvidia would need to increase its revenue to about $308 billion a year, assuming its PS stays the same. According to Wall Street, Nvidia's revenue is expected to expand by 33% in 2027, 18% in 2028, and 26% on average over the next 5 years. The corporation may attain a $7 trillion market valuation as early as 2028 if it can overcome those comparatively low obstacles. Nvidia has a history of surpassing Wall Street's consensus projections, though, so I have a feeling the business will surpass that standard sooner rather than later. Don't believe anything I say. CJ Muse, an analyst at Cantor Fitzgerald, recently raised his price objective for Nvidia from $240 to $300 while keeping his rating at overweight. Buy. For investors who are keeping count at home, that is a 56% potential gain over Thursday's closing price, which would raise Nvidia's market capitalization to $7.3 trillion. This week, Muse said in a note to clients that the AI sector is moving at exponential speed. He continues by predicting that demand will be driven for years to come by corporations and neo-cloud companies. According to the analyst, we are still in the early stages of this investment cycle, so this is not a bubble. We cannot envision a situation in which Nvidia does not eventually acquire at least 75% of the AI accelerator business, which is perhaps even more significant, Muse said. Lastly, the current price of Nvidia stock is almost 30 times the company's earnings for the following year. Some may argue that's a premium, but I think it's a good price for a business that's expected to have double-digit sales and profit growth until the end of the decade. After consulting with Jensen Huang, the company's CEO, CFO, and other senior officials, Cantor Fitzgerald raised its price objective for Nvidia from $240 to $300 while maintaining an overweight rating. The AI market is not a bubble, the investment firm emphasized, and it is still in the early phases of a multi-trillion-dollar infrastructure build-out. According to the company, hyperscalers by themselves provide insight into the hundreds of billions of dollars in demand that will arise in the upcoming years. The recent collaboration between Nvidia and OpenAI, which is anticipated to assist OpenAI in establishing itself as a self-hosted hyperscaler, was also mentioned by Cantor Fitzgerald. According to the company, Nvidia's earnings per share would be $8 by 2026 and $11 in 2027. Compared to the consensus forecasts of $6.26 and $7.36 respectively, this is significantly higher. Additionally, according to Cantor Fitzgerald, the business will eventually account for at least 75% of the market for AI accelerators. The American multinational technology business Nvidia is well known for creating high-performance computing (HPC) solutions, AI hardware and software, and graphics processing units (GPUs). The company's strong demand for its potent GPUs has greatly increased Nvidia's stock price. The stock price will probably experience significant downward pressure if AI spending slows down. Probably the first company that springs to mind when someone mentions artificial intelligence, AI, is Nvidia. The thriving tech company is contributing to the global expansion of AI infrastructure. There shouldn't be any complaints from shareholders who have been riding along. Here is how much money you would have now if you had purchased $500 worth of this booming AI stock 5 years ago. A $500 investment over the previous 5 years would have grown to an incredible $6,800 today thanks to Nvidia shares. The overall return is 150%. With a staggering market valuation of $4.5 trillion, Nvidia is currently the most expensive company on the planet. Considering how much money businesses are spending on AI-related infrastructure, it appears that they have no intention of slowing down. Customers' insatiable demand for Nvidia's data center graphics processing units has directly benefited the company. In the second quarter of fiscal 2026, Nvidia made $46.7 billion. Compared to precisely 5 years before, this was a staggering 618% growth. The top line is expected to expand 149% between fiscal 2025 and fiscal 2028, according to Wall Street analysts. That's a promising perspective. However, Nvidia's stock may see a sharp decline if there is any indication that AI spending is slowing down. Nvidia intends to contribute $100 billion to OpenAI. Spending on Nvidia computer processors will rise as a result of the collaboration. If artificial intelligence, AI investment keeps rising as a result of this agreement, Nvidia's market capitalization might approach $10 trillion. It all comes down to computing power. That's what OpenAI CEO Sam Altman claims, however. With over 700 million weekly active users and a fast-expanding user base, the artificial intelligence, AI, disruptor has been inking agreements to help finance its rising need for data centers to run its ChatGPT systems. The arrangement with Nvidia is the biggest of these. Nvidia will progressively invest $100 billion in OpenAI, which will use the funds to purchase Nvidia chips in order to construct AI data centers with a capacity of at least 10 gigawatts. In addition to being a potentially profitable investment for Nvidia, this should result in a significant increase in revenue for the remainder of the decade. As of this video, Nvidia's market capitalization is at $4.6 trillion, making it the highest in the world. Will Nvidia become the first $10 trillion stock in history as a result of this recent OpenAI deal? Let's examine the offer more closely and find out. Nvidia and OpenAI jointly announced a potentially game-changing strategic alliance on September 22nd. OpenAI differs from major cloud providers like Alphabet, which have invested years in developing AI-ready infrastructure. Despite its size, OpenAI is still not profitable and requires a significant amount of funding to realize its AI mission. For AI data centers, Nvidia is the primary supplier of graphics processing units, GPUs. OpenAI's finance structure has become more inventive in the absence of the large tech balance sheets. OpenAI will use the approximately $100 billion that Nvidia will gradually spend in it to construct data centers using Nvidia computer chips. In order to create 10 gigawatts of capacity, this may equate to millions of GPUs bought from Nvidia. The capacity of data centers in the US is thought to be somewhat more than 50 gigawatts at the moment. Accordingly, the estimated expenditure from OpenAI using Nvidia GPUs may end up increasing the footprint of data centers in the US by 20%. This enormous scale should help us properly contextualize the $100 billion and 10 gigawatt claims. Nvidia is already the biggest corporation in the world by market capitalization because to the AI data center development. It generated $86.6 billion in bottom-line net profits on $165 billion in revenue over the previous 12 months. In 2026, OpenAI won't boost Nvidia's earnings by $100 billion. However, it might gradually increase Nvidia's yearly revenue figures by tens of billions by 2030, which would have a significant impact compared to its present level of $165 billion. Remember that OpenAI sells to companies like Meta Platforms, Microsoft, and Amazon for their own data center expansion plans, so it's not only Nvidia's clientele. Additionally, we must not overlook the investment in OpenAI. Although Nvidia's $100 billion investment in OpenAI might not result in trillions of dollars in value, it might be very profitable if OpenAI grows into a trillion-dollar firm, and Nvidia controls 10% of it. However, 10% isn't a precise number. When it comes to investing in AI infrastructure, OpenAI is setting the bar high. To catch up in the AI race, other rivals will have to increase their expenditures to match what OpenAI is creating. Spending more on Nvidia computer processors will result from all of this. If the company's market value is $4.6 trillion today, and its sales is $165 billion, it will probably need to generate at least $300 billion in revenue annually in order to reach a $10 trillion valuation. Nvidia's net income margin is at 53%. Nvidia will have $185.5 billion in net income at some point this decade, if that margin is maintained with $350 billion in revenue that comes in due to OpenAI and other companies' massive investment levels. That would result in a price-to-earnings ratio, PE, of 54, which is costly, but it is comparable to Nvidia's current PE of 53. Even though it seems improbable, OpenAI's acquisition might push Nvidia to a $10 trillion market valuation by 2030. Just don't buy the stock with the expectation that it will happen tomorrow. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
When we think about how this market could turn. What are your expectations for this market? I mean, Jamie Dimon today, actually, I saw that he had a 30% likelihood of a correction, and then he was a little more worried than most, but he often is, right? He always sort of gives us the downside scenario. That's sort of been his track record. What is your scenario, maybe a base case on this market, and if it does dip, what do you do?
Yeah, Jamie Dimon is a banker. They tend to be conservative. I would know my dad was a lender as well, so I have experience with that. Typically they're able to look and see the downside, before maybe they pay attention to the upside. So I take his comments, but with a little grain of salt too. I expect AI to continue to lead the market. I think AI spending expectations are going to be revised higher, as I mentioned. And then we see token usage from the big hyperscalers, also Google, OpenAI. Those numbers are doubling every couple months. And that indicates that consumers and businesses are engaging with these chatbots and other AI applications, and it's growing dramatically. I think that's going to continue. And so I expect these big tech AI leaders to continue leading the market. That includes Nvidia, Google, Microsoft, Amazon, Oracle. You can go on down that list.
I actually had a guest today who said, I still like bonds in a portfolio for the next decade. And I just don't really have a lot of guests who say that anymore. We always thought about how our parents were saying, 60-40 or, equities and bonds, and that bonds were the safe haven. But really, if you look over the last, since the bull market, you really missed out on 20% years and what's going on now this year. What do you tell someone who always is a little risk averse and used to investing in bonds? What do they do now? They may still have the bonds sitting there. They missed gold. They missed all the tech.
Yeah. I think if you're an investor with a time horizon that extends beyond, say, 5 years, that equities are probably a better option for you if you can handle and stomach the natural volatility that the stock market offers. Take Nvidia, for example, one of the best performers in the stock market over the last 10 years. It's also had really big drawdowns over that period. In fact, I think it was down more than 30% at one point this year, a couple months into the year, but is now up, whatever it is, 30, 40, 50% year to date. So if you can stomach the volatility, if you can invest for a long enough time period, say 5 years, I think equities are probably a better bet than bonds going forward.